What if doing nothing fancy actually beat chasing the next hot stock? Think about that for a second. In August, US stocks roared back after July's brutal pullback. And I mean brutal. Strong big tech earnings turned all that artificial intelligence spending into real returns. Not promises, returns. Cooler Middle East tensions knocked West Texas Intermediate crude down over 3%. Just like that. The Dow and the S&P 500, they hit fresh records. The S&P even crossed 7,700 points. 7,700. But here's the catch, and there's always a catch. Records do not mean risk vanished. After hours, advanced micro devices fell nearly 10%, despite huge growth. Let me say that again. Huge growth. Revenue rose 50%, and data center sales doubled. Doubled. The problem was expectations. Because Wall Street wanted even more. And SpaceX's first post-IPO report? It told the same story. Revenue jumped 92%, yet shares still dropped 7%. Wild, right? Heavy artificial intelligence data center spending squeezed profits hard. And that, right there, is the emotional trap of this market. Indexes look unstoppable, while single earnings misses get punished fast. So investors feel greedy and terrified at the same time. Maybe you felt it too. The calm answer? It's boring. Monthly investing into broad index ETFs. That's it. Now, here's the test everyone asks about. Invest $3,000 monthly for 2 years. Simple. By July 23, 2026, the results were striking. QQQ grew to about $19,500. $19,500. VOO reached about $13,600. Same habit, different index. Both built 5-figure gains. Now remember, past performance never guarantees future returns. Never. So why did simple monthly buying work so well? 2 reasons. First, dollar cost averaging turns fear into discipline. When markets fall, your fixed contributions automatically buy more shares. When markets rebound, those cheap shares lift the whole position. That means buying less near peaks and more near panic, automatically. Second, these indexes sit on elite corporate moats. Their members generate enormous cash and keep pushing earnings higher year after year. For growth seekers, the NASDAQ 100 is the aggressive lane. QQQ concentrates in Microsoft, Apple, Nvidia, Alphabet, and Meta, the heavyweights. It swings hard, but monthly buying smooths the ride. It fits investors who want artificial intelligence upside and can accept the turbulence that comes with it. For steadier exposure, the S&P 500 is broader. VOO spreads across technology, finance, consumer, and healthcare. Leaders. It can act like a stabilizer when sectors rotate. Now the practical playbook. Build a moat around your cash. Defense starts with money market funds or ultra-short treasury ETFs. They pay interest while keeping your powder dry for real bargains. Then automate monthly buys into QQQ or VOO. Set it and forget it. Let America's strongest companies compound, while you sleep. Offense? That can be a small sleeve of thematic ETFs. Think semiconductor or technology funds that bundle many leaders together. They can explode higher when momentum returns. But they can also crater during sharp technical corrections. Both things are true. So, size them small and use monthly buying there too. Never, and I mean never, let a hot theme become your whole balance sheet. The real edge is not prediction. It's process. Automate the boring part. Before your emotions try to negotiate with you. So, what would you choose? QQQ, VOO, or a cash plus satellite mix? Drop your take in the comments, and as always, invest carefully.